Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Matthew Piepenburg, who is a partner at Von Greyers, also writes on gold, silver, and wealth preservation. Matt began his finance career as a transactional attorney before launching his first hedge fund during the Nasdaq bubble of 1999 to 2001. Matt, thank you for taking time out today to be with us.
Well, thanks for inviting me. Always enjoy talking about macroeconomics and the world at large, and there's certainly lots to talk about these days, so I'm looking forward to it.
Yes, definitely a lot to talk about, and undoubtedly we will get on to gold and implications of what's happening in that market later on. But
Mhm,
I wanted to start with yield prices and the correlation between currency debasement and yield prices, because
mhm,
I know that there's a lot of concern, well, maybe from the US government that, as we're recording, the 10-year bond yield is 4.37%,
mhm.
probably a bit higher than I think they would like it to be for refinancing purposes. Um,
Sure.
but yeah, please do go into that correlation between currency debasement and rising yields and what we're seeing at the moment.
Yeah, no, it's a very important topic. I mean, I've always written about bond yields. Rising bond yields are like shark fins to the markets and to national security and the national economy because rising yields, especially on the US 10-year, which is the sacred cow bond of the global international kind of sovereign bond world, the tier one asset under the BIS, that 10-year US Treasury is a very important beast. And I've always said the bond market is the thing. If you understand the bond market, it makes conversations about just about everything else a lot easier. But net, when bond prices go down, yields go up. When there's less demand for bonds, bond prices go down and yields go up. And when yields go up, the cost of credit, the cost of debt gets higher. And so rising yields to an indebted company or an indebted nation are shark fins approaching. They're scary. And so you want to control those yields. It's very, very important to keep those yields down. Typically, when markets see massive volatility, like we saw recently, you would hope that US 10 years in particular would be a safe haven for investors and that there would be a crowding into that bond because of market fears in the equity markets, and that bond yields would therefore go down because bond demand is going up. And what we saw in this recent headline making event since Liberation Day, as Trump would call it, when the tariffs were announced, that not only did the stock market go down, but bond prices went down and yields went up. So that was very terrifying because that meant that the cost of Uncle Sam's debt, just like the cost of debt around the world, becomes more expensive. And typically, when there are rising yields, if the yields rise in the US, the dollar gets stronger. If you have trillions of dollars in dollar denominated debt around the world, that doesn't mean debt necessarily paid to US banks, but owed in US dollars. When those yields go up or that dollar gets stronger, it makes the cost of debt painful for all those foreign borrowers in the offshore markets as well. So again, rising yields are terrifying. When Powell at the Fed was intentionally rising rates at the Fed funds rate level, that also created a lot of havoc. We saw basically we saw a banking crisis in 2023 because of rising yields. It wasn't really a banking crisis, it was a bond crisis, and it was a yield crisis. Bond prices were going down, yields were going up. In 2022, when Powell began the higher for longer by raising rates, we saw the worst nominal returns in stocks and bonds since 1871. So again, it all comes back to that otherwise boring but so critically important topic which you introduced at the beginning of bonds and yields. And it's understandable that many people listening have many other things on their mind other than bond yields or understanding bond markets. I fully understand that, but it's important that everyone gets a basic understanding of the inverse relationship between bond prices and yields. When bond prices go down, yields go up. When bond prices go up, yields go down. And obviously, bond prices are based on supply and demand, like everything else. So it's a very, very important topic. And the demand for Uncle Sam's U.S. 10-year, his IOU, has been steadily declining for years. And so that was just heightened in the last headlines. But it's absolutely essential that people understand rising yields are scary and terrifying things for anyone or any nation or any entity that is highly in debt. And given that the US has never been at higher debt levels in its history, and given that the world has never seen higher debt levels in its history, given that debt is the key cornerstone of the rotten wind beneath the wings of so called growth, those rising yields are absolutely critical, Robert. And so, and again, it goes into every string we can pull on, but the Fed, like many central banks, have a narrative that their main mandate is inflation and employment. But the Fed's real role is keeping those bond yields under control because the Fed basically controls the cost of debt. If those yields go up or those rates go up, that makes the cost of debt higher. When Uncle Sam owes 37 trillion in public debt and yields or rates go up, that's called fiscal dominance. They can't raise rates to fight inflation because yields and rates get too high. They can't afford their own interest expense on the debt. So it's complicated but simple. Rising yields make debt more painful. Debt is the rotten wind beneath the wings of the US and global economy. When you have too much debt colliding with rising yields, you have an uh-oh moment. And that is certainly an important topic, Robert. And again, whether we talk about tariffs, the stock market, the bond market, currencies, it all comes back to the central thesis of credit and debt getting out of control. And we can, like I said, we can pull on any of those strings. It all comes back to bonds, credit, debt, liquidity, currencies. And of course, when currencies are losing value, or when they have to print more money to create more liquidity to pay for that debt at higher rates, that debases the currency. Fiat money gets weaker, precious metals go higher. And so it's all connected.
Yeah, I have a feeling we're going to be seeing quite a bit of QE, I think, across the board. I was looking at what was I looking at? I was looking at something on X the other day. I don't remember who posted it, but it was a picture of the various bond yields from around the world, and it was they were all just green arrows, which
Yeah.
not good.
Yeah.
Certainly
Yeah.
not good.
Yeah.
I think given everything that Trump has come out and he has in the last couple of days or so has been attacking Powell somewhat. I feel
Mm-hmm.
sorry for Powell in a way that he's almost backed into a corner and he's damned if he does, damned if he doesn't.
Mm-hmm.
If you're in his shoes, and
Mm-hmm.
obviously the next Federal Reserve meeting is in May,
Mm-hmm.
assuming there's not an emergency one beforehand. If
Mm-hmm.
you're in his shoes, given all the economic things that you've just mentioned,
Mm-hmm.
what would you do, or what would be the most reasonable solution for the next Fed meeting? Raise, lower, keep the
Mm-hmm.
same. What would you do?
Yeah, I'm speculating. I mean, I've been very critical of Powell on countless occasions, but to your point, there's other times where I've had to play the devil's advocate and almost have sympathy because he is trapped. He is damned if he does, damned if he doesn't when it comes to printing more money or lowering rates to solve this most recent crisis. In his most recent press conference, he was asked, "Will you just throw bazooka money the next time the markets go into a V or go down before they V up? Will you QE to the moon?" And his very smug response was no. In other words, he's saying don't rely on the Fed to bail out every problem. Um, and in that, but you have to understand that Powell is a political beast, and you have to know how to speak Fed speak and understand the corner he's in. What he really said was no, the Fed won't just do that automatically just because markets go down. He said the Fed would only resort to more money printing or QE, or I call it mouse click money, because all it really means is adding a zero to the balance sheet. They literally, they take some coffee, some Dunkin' Donuts, they walk in the Eccles building, and they just create money. It's literally that simple. But he said, we won't do that unless the markets become dysfunctional. So now you have to translate that in Powell speak into everyday human awareness speak. And it goes right back to your original question, Robert, because what that means, unless markets become dysfunctional, is unless bond prices tank and yields go to the moon. So if bond prices tank, as they're doing, as yields are rising, if it gets more and more out of control, that's dysfunction in the bond market. If no one is buying Uncle Sam's IOUs, who else can do it but the Fed? And so to buy Uncle Sam's treasuries, you have to go resort to QE. If you do QE to save the bond market to keep yields down, that's also helping the stock market. So his answer was a yes and a no, but it's really a yes. I will bail out the markets when they become dysfunctional, not when there's a 20% retracement in the S&P or the Nasdaq or the Dow, but if bond yields shoot up, he'll have to QE to sponge up that unloved US Treasury. And of course, when you're supporting the bond market by printing money and bringing rates down, the stock market, which runs on debt and leverage, will go up. So, in a sense, yes, he will, but don't look at the S&P, look at the 10-year US Treasury yield to your original question. Believe me, Powell is looking at that yield more than he's looking at the Nasdaq or the Dow. But again, he is cornered though, because if he prints more money to save the bond market, he debases the currency further. And we just solve a debt crisis with more debt, issuing more US Treasuries and then monetizing that debt with money literally created out of thin air. That is not a sustainable solution. It's been working since 2008, but it's getting weaker and weaker. The Martini effect is getting weaker. And of course, the gold prices are ripping because faith in US fiat money and faith in the US IOU is in a bear market. So gold is in a bull market. It's all very simple. It's not a gold bug propaganda. It's not selling my book. It's understanding, ironically, the bond market and the rates market and currencies. And so gold is an obvious solution, as Egon understood 20, 30, 25 years ago. But again, he is in a kind of sympathetic scenario where he's running out of options. He wanted to tighten, he wanted to raise rates. Markets in 2022 went crazily poor after that. He created a banking crisis. Again, all of these things are liquidity crises coming from too much debt. The repo crisis in 2019, the quote unquote COVID crisis in 2020, the 2022 market implosion, the gilt crisis in the UK was a derivative of our rate policies in the US, rising rates. And then, of course, the banking failure in 2023 and what we're seeing today. So they're all different needles pointing to the same balloon, which is a red pile of debt balloon, and it's limiting his options. It's either inflate or die, which means you've got to QE to the moon at some point to keep those unloved bonds bought. And the reason they're not bought is because we weaponized the bond or we weaponized the FX reserves of a major nuclear power in 2022. Whatever you think of Putin or Zelensky, it's irrelevant. When you weaponize that dollar, there's distrust in the US Treasury. And the BRICS have been de-dollarizing. The oil markets are slowly moving away from the petrodollar. So demand for that dollar, despite Brent Johnson's milkshake theory, is weakening because trust in our US Treasury, our 10-year, is falling. And since 2014, central banks have been net dumping US Treasuries and net stacking gold. So these aren't gold bug apologies. These are hardcore realities in the bond market that signal everything else. And so Powell is in a corner. If no one else is showing up at US Treasury auctions, and believe me, after Trump announced his tariffs, no one showed up at the Treasury auctions. That didn't make the headlines. Yields were spiking. And I guarantee you, without proof, Bessent walked into Trump's office and said, "We got to pull back on this tariff announcement." And they did, not against China, but they did because they were worried about your first question, Robert, bond yields rising. Those are terrifying. So Powell, what can he do now? He can lower the Fed funds rate. He can go from QT to QE, but he won't do that just because the markets are down. He'll do that when the bond prices keep tanking and yields keep rising. There is a point where he has to step in. And to track that, don't track Nvidia, don't track the Nasdaq or the S&P. Track the yield on the 10-year. I've always said the bond market is the thing. It's a twist on Shakespeare. The bond market is the thing. Please just understand rising yields are very, very scary things for debt-soaked countries and debt-soaked companies, which is why bond prices and stock prices are correlated now. They fall together rather than hedge each other. So it's a fascinating dysfunctional time because there's just too much debt in the world.
I really appreciate you deep diving into that. And that was the purpose of asking the
Mhm.
first question originally was that, yes, I appreciate everyone is, well, a lot of people are going to be looking at, the S&P and the stock market this and stock market that. But
Mhm.
actually, when you dig into the weeds, actually, it's that bond yield price that really
Yes.
need to be looking at because that will tell you
Yes.
a lot of things underneath the surface.
Mhm.
Um, talking of talking of underneath the surface, Trump tariffs,
Mhm.
China buying more gold, selling off treasuries. That's probably having an impact on the
Mhm.
price of gold slash devaluation of currency. Uh,
Mhm.
dig into that as you
Mhm.
will.
Mhm.
What are we seeing at the moment?
It all comes back to the bond market, Robert. Again, if China and Japan, for example, were traditionally our biggest buyers of U.S. Treasuries. So when they're buying treasuries, the price goes up because demand goes up and yields come down. That's a good thing. Obviously, when you're throwing 100% plus tariffs on China, they're not going to be buying more US Treasuries. They're going to be dumping them. So that's going to push pressure on the price down on bonds and yields up. And so, this is why the tariff thing is probably more than a 1 minute answer. It starts with the bond market, but it really goes back to what we're going to keep saying, a debt crisis, right? And to to understand Trump and to understand what this fiasco is and why markets and bond markets and stock markets are gyrating, why the VIX was at 52, why they pulled back on the tariffs against the EU and the UK, you have to understand debt. And you have to understand the different perspectives of debt, the American narrative versus the cold reality. And this is not anti-Trump or pro-Trump, but to really answer it fairly, you have to put yourself into the shoes of Trump, and then to put yourself into the shoes of the rest of the world, and then put yourself somewhere into the shoes of America. And all those three circles overlap at a point. Trump, to play the devil's advocate, thinks these tariffs are essential. And there are three main reasons. First, he looks at the BRICS and the rise of the BRICS, and he's really looking at China in particular when he looks at the BRICS. And he sees hegemony in the US drifting away, dollar hegemony drifting away, de-dollarization coming, China rising. And believe me, China has many problems, but it's rising relative in a lot of ways. And he's threatened by that. He sees a $300 billion trade imbalance with the BRICS. And so to him, in Trump's mind, America is the sucker. That's first thing. He also sees fentanyl and horrific drugs coming in through the borders of Mexico and Canada, and he wants to punish or change that. A lot of those drugs he thinks are manufactured in China and seep through these borders north and south of the US. So these tariffs are meant to create policy changes in the rest of the world to stop that. But again, the main thesis for Trump is, we're the suckers. We need to do something. Okay. And then the third and most important reason he's doing this, and I think the key reason, is the American dream, as I've said many times, is now made in China since 2001 when the World Trade Organization let China in. That wasn't the fault of the Chinese that many US CEOs who manufacture widgets all over America decided it'd be cheaper to manufacture those same widgets in China, South America, particularly East Asia and Eastern China, because that makes labor cheaper, makes profits higher. CEOs get paid on share prices and margins. So very good for the CEOs, very good for the stock price. But 6 million Americans lost their jobs when we outsourced labor to outside the US. So Trump is extremely furious about that, legitimately so. And so another reason he's doing these tariffs is to force companies like Apple to get operations back in the US, and John Deere, which used to be made in Iowa, my neighboring state, is now made in Mexico. So he's trying to force manufacturing back into America, put the P back in the GDP. You can't fault him for that. So that's playing the devil's advocate for Trump. Now step back and look at the rest of the world, especially in the BRICS. And they're saying, you think you're the sucker? We're the sucker. We've been the sucker ever since the US dollar lost its gold backing. You exported your inflation to the rest of the world. You forced the US dollar on us. It's not redeemable in anything real. It's redeemable on an asset that's being debased, the US dollar. They call that seigniorage. The Fed, the IMF, the World Bank, whenever they make a policy, the developing economies of the world have to eat that sandwich. They have no choice. They have to debase their currency if America inflates its currency. So they're saying we're the suckers. And they're saying your banks like the IMF and the World Bank, if you read John Perkins' book, Confessions of an Economic Hitman, these BRICS nations and other nations are saying we've been exploited by usurious and unfriendly, horrific loans that are just meant to take over our natural resources. And you interviewed Alex Craner. That's a form of financial colonialism. So they're the ones who think they're the suckers. And then you got to keep in mind, again, this isn't an exaggeration. Jeffrey Sachs just spoke at the Atlanta Diplomacy Conference, I think it was a week ago, and he's talking about this objectively, not as an Ivy League intellectual or an elitist, but as a simple, common sense, knowledgeable academic who understands these things quite well. And he said, he made a really interesting thing. He says, we look at our current account deficits in the US. That's very simple. You take national income, which is government spending and consumption investment, you subtract from that GDP and you get a current accounts deficit. That's all wonky math, but we have a $2 trillion current accounts deficit in the US. Why do we have that? Is that the fault of China or the BRICS? No. It's the fault that the US government, which has a credit card, spends infinitely more, 2 trillion more than it creates. So you can't blame that on China. Tariffing against China and other nations isn't the fault. And he used a very good analogy. If you have a credit card or your wife has a credit card and she goes into a mall and goes to 15 different shops and spends far more than your income allows, you can't then blame the bill on the shop owners in the mall that you're spending more than you have income. That's not their fault. They're they're not to be blamed, but yet Trump, love him or hate him, is creating a narrative where we're the suckers and we're blaming the rest of the world and the BRICS in particular and China and specifically for our current accounts deficit. But the current accounts deficit starts at home, spending more than you produce. So what Sachs is trying to say, and what I'm trying to say is, and what the BRICS are trying to say is, despite Trump's narrative, and despite what I even agree with in the sense of trying to reshore jobs, this is not the way to do it. And I think USA is only 12% of Chinese exports. Putting a tariff on China, 140% some levels, isn't going to hurt China in the same way it's going to hurt the US. And so it's a very complicated thing, but it comes down to the original theme, which we'll always come back to, debt. And America is in too much debt and it has a current accounts deficit because it spends more than it produces. You cannot blame that on China. You can't blame the offshoring of jobs on China. That you can blame on the CEOs of companies like Apple or John Deere. That's a simple fact. And so we're getting this kind of America first, chest puffing, Trump doing things great. But a lot of the faults lie right within the US. They certainly lie in the C suites of most of our companies. If you go to a Walmart or you go to Costco, 95% of the things on those shelves with an American flag are actually made in China. That's the fault of the CEOs of those companies. So again, that's not being anti-American. That's just being honest. Frankly, if I were going to put a tariff, I put a tariff on the salaries of the CEOs of those companies that offshore those jobs so they could have second or third homes in Palm Beach or Nantucket or wherever, because that really is fleecing the American middle class to get effectively slave labor overseas to have higher margins. So again, all these policies and all these discussions and all this America firstism is somewhat missing the real point. And whether you're Jeffrey Sachs or me or someone else who's looked at this more carefully, and I'm an American and I'm a patriot, but you have to be honest about what our problems are. And it's a debt problem. And so by putting blanket tariffs on of even 10% and then massive tariffs against China, um, you know, that's going to just create higher costs and higher, it's a tax on the middle class. Ascent and Trump call that short-term pain for long-term gain because eventually these tariffs will induce, especially American companies in China, to come back to the U.S. So it's that I applaud, but I think the methods we're going to get that are going to be highly painful, highly inflationary, and then actually deflationary at first because the American middle class is strapped. They're broke. They're the working poor. So they're going to go into a deflationary spiral, a recessionary spiral, which is deflationary. But Powell's only option when we're in a recession is to deficit spend and bazooka money the solution, which is an inflationary response. So the end game is inflationary. The short-term pains could be very disinflationary or deflationary or recessionary. And certainly if the markets mean revert, that's disinflationary. But going back to your question, what are Powell's options? They're all connected here, all these themes. The only option is to print serious amounts of money to cover those gaps in the deficit spending and to buy those US treasuries and to keep our working poor middle class above water. But that will be at the expense of inflation, the debasement of the currency. And again, that's why gold and silver have nowhere to go secularly, but up, because the dollar has nowhere to go but secularly weaker because of this debt. And I think after that bazooka money fails, then we're talking about more esoteric, dysfunctional global resets that the IMF telegraphed in 2020. So there's a whole chain of dominoes that still has to happen. We're seeing it play out in real time right now, though, Robert. History is happening right now. And sometimes it's hard to see it when you're in it. But we are at the climactic exponential phase of a empire not dying but changing, and a dollar not dying but changing, and a hegemony that's disappearing, just like in the Netherlands, just like in the UK, just like the Habsburg Spain, just like the Dutch. Empires rise and fall, currencies rise and fall, That doesn't mean the nations fall and die and disappear. America will still be here in 20 years, whatever for whatever condition it's in. It just won't be the America it was 20 years ago. And countries like Mexico and Canada and certainly the BRICS, love them or hate them, have seen the writing on the wall. And no one saw this more carefully than China. They've seen this since really 2008. Xi looked in the Chinese looked at Bernanke's playbook when they printed money to get out of a debt crisis by creating more debt and monetizing that. And they said that US Treasury isn't going to be the same. That dollar is not going to be the same. The Chinese play chess. They've been watching this for years and they're prepared. They're stacking gold like other central banks in the East at higher levels because they know the dollar is not going to die. It's just going to get weaker. It's not going to be preeminent. Its supremacy is going to change. And again, that's not being anti American. That's actually being honest. If you want to be a patriot, you got to call this out. You got to understand this, and you got to understand it beyond the current narrative, left or right. Again, I can applaud Trump for trying to reshore jobs. I think that's essential. I can applaud Trump for the optics and the reality of trying to cut spending through the Doge program, cut waste, US aid and all the fraud we saw there. Fine, that's fantastic, but that is a band-aid solution to an open knife wound of debt. That alone, US aid, Doge, and certainly tariffs are not going to do anything in the near term to solve our debt crisis. So we are going to see short-term pain, maybe longer term gain. But I think that short term pain is going to be much longer than Besant or Trump realize. And I think the depth of that pain is going to be deeper than they realize. And already, again, Powell could not beat inflation by rising rates. He never beat inflation. In fact, because he tried to raise rates, that just made the cost of Uncle Sam's debt too unpayable. So he failed. He failed because our debt was too high. It's called fiscal dominance. Trump will fail with his tariffs because our debt is too high. We just saw it last week when he announced these tariffs. Within a day, he had to pull back, not because the S&P was tanking, but again, to your point, bond yields were rising. We're in too much debt to create instability, because if we create instability, we create a bond yield crisis. And so we're trapped. We're trapped in a debt spiral. It'll be very interesting to see what happens in the next few weeks. I don't know. I can't get into Trump's mind. I got to believe that Besant understands this as a scholar of history and markets. But what I will say for the Trump administration, unlike the prior administration, I'm apolitical. I'm a cynic, left or right. I think they're both faulted. But you can at least argue that Trump's series concatenation of executive orders, his attempts to do something, he's a bull and a bear in a china shop, is to some people more vigorous than Biden, who was literally brain dead for 3 to 4 years in term. And that's just true. So, but the problem is for many, understandably, is Trump's executive orders look a lot more like an oligarch than a president. And so there's always going to be criticisms. But again, I've said openly, it doesn't matter who's in office today. It doesn't matter who's at the Fed today. It could be Santa Claus. No one can solve the debt crisis we're in today. And there's going to have to be what Schumpeter of the Austrian school famously described as constructive destruction. You can't drink this many martinis of printed money and postponing debt and solving a debt crisis with more debt paid for with mouse click money. You can't do that indefinitely. And what we're seeing now is the jig is up. It's up. There's too much volatility. The only solution is more bazooka money, which means more inflation, more debased currency. And that explains why, central bank purchasing of gold has tripled in the last 3 years. And that explains why the BIS has made gold a tier one asset, a strategic reserve asset, alongside the US Treasury. But that's laughable, as Egon would say. That's laughable. The US Treasury, the 10-year, isn't a tier one asset at all. It doesn't beat inflation. And it's a completely disingenuous asset at this point. The gold, which is that pet rock that stares at you and does nothing, actually does a lot of things. It holds its purchasing power and it preserves your wealth. And that's the entire message we've had for gold. Egon bought gold at $300 an ounce many, many years ago, lots of it. He's certainly happy to see it go up 10x in price. But that's not why he bought it. He just knew that that gold was going to hold its value better than a Swiss franc, a euro, a Swedish kroner, or a US dollar. And it certainly has. It certainly has. But more, yeah, in addition, the price has gone up 10 times. So he's made money, but he's preserved money. And the real motive for Egon and all of the partners and all of our clients is preservation. We don't look at gold to get rich. We look at gold as a way to avoid getting poor by the invisible tax of inflation and the debasement of your currency, whether it's a peso, a yuan, a ruble, a US, Canadian, or Australian dollar. So, it's really understanding debt, credit, yields, and frankly, history. It's a fascinating time. It's a very stressful time, though, very stressful, with no way out.
No, it's definitely there's definitely no way out. I think if
Mhm,
as you've just alluded to, so many points there, um, Matthew. To be honest with you, I was going to ask you about Doge, but you've actually just covered it
mhm,
with everything you've just said. We will get on to gold. We'll get onto that subject
mhm.
now. And yes, going on to history, very important. That I know, a lot of people are getting quite, dare I say, excited about what's happening with regards to the gold price
Mhm,
itself.
mhm,
And that's why I've started writing articles looking at the history of
mhm,
things that have happened with gold, looking at
mhm.
gold silver ratios over time, and
Yeah,
what role did gold play in Britain's golden era and stuff like that. And you
right.
can see that history doesn't always repeat itself, but it's
Mhm,
certainly a rhyming thing.
mhm,
Moving on to gold, then obviously a lot
mhm.
of people keeping eyes on it at the moment. It seems to be in a some form of parabolic stage price wise. And
Yeah.
I know you've covered a couple of the fundamentals in your answers. Let's
Mhm,
just go through these fundamentals again of gold. Why is it
mhm,
useful? What's it for? How can it
mhm,
help people? Let's
mhm,
start from the basics. I always like to give
mhm.
layman's terms in.
Yeah, no, I appreciate that, Robert, because I really, again, a lot of us pundits or executives, or certainly Wall Street veterans, for better or for worse, have a lot of wonky language. And it really is complex, but unnecessarily so. You can show graphs and yield curves and charts and spreads and look at credit swaps, blah, 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 blah. But let's try and understand gold in simple ways, because whether you're a brain surgeon or a plumber, you've got other things on your mind than understanding economic history or charts. And so sometimes you have to keep it simple, stupid, because it really is that simple and that stupid sometimes, how crazy money works, and how gold as a wealth preservation asset works. And one example we've used many times, you could use it with a toga in Rome, you could use it with a suit on Seville Row, or you could look at an example of a house purchase in the US in the terms of what gold really does do in preserving wealth more than any currency, whether it's the world reserve currency or the Argentinian peso. And so, you know, I use the example of 1920 America before the Great Crash. It was the American dream to buy a house. And in 1920, the average white picket fence American house in the suburbs of Chicago or Los Angeles or Toledo or anywhere was about $5,000. And in 1920, the cost for an ounce of gold was $20. So a little ounce coin was $20. So in 1920, if you're a generous father and you want to give your son or daughter a house, you could give them $5,000 in cash, and they could buy a house, or you could give them 250 $20 20-ounce coin, or 250 ounce coins of $20 per ounce. So a box of 250 ounces of gold would buy you a $5,000 house in 1920. But if you were thinking for your grandkids' generation and you wanted to make sure they had a house too, you could also give them $5,000 in 1920, or you could give them that same shoebox with 250 gold coins. Now, if you gave them that shoebox of cash and they wanted to buy a house in 2025, $5,000 wouldn't pay for the down payment, wouldn't pay for the landscaping, wouldn't pay for the driveway. But if you kept that same shoebox that you had in 1920 with those 250 coins at $20 an ounce then, well, now at 3,000 or $3,400 an ounce, that same shoebox of coins that you had in 1920 that bought you a house in 1920 would still buy you a seven or $800,000 house today. It's the same thing. But that $5,000 in cash had none of its purchasing power. So my point only is those gold coins in 1920 could buy as much today as they could then and then some, because they held their value. But the dollar, those $5,000, didn't do much for you over the last 100 years. And that's the point, is this precious metal, this pet rock, this indestructible metal that's been there before even the creation of the universe, the Big Bang Theory. It's literally part of our DNA. There's a list of like 0.2 tenths of an ounce of gold in our body. There are biblical analogies, but I'm saying gold is something special. It's not just a metal, it's a monetary metal, it's an indestructible metal, it's a highly rare value, it has a stock to flow ratio of 60. It is a scarce asset, it's indestructible. Unlike the US Treasury, which is of infinite supply, gold has a fixed supply. And so this understanding of gold, which people have poo-pooed as a pet rock or an analog, outdated asset, just stares in the ground and sits back and does nothing, stares back at you. That's absolutely disingenuous. And look, it holds its value more than any paper currency in the world. And since 1971, when the US dollar got off the gold standard, the US dollar has lost 99.3% of its purchasing power versus a single milligram of gold. That needs to be repeated over and over in people's minds. Gold didn't make you rich, but the dollar made you poor because it doesn't hold its purchasing power. It doesn't preserve. It is not a store of wealth, which is one of the key components of what is real money. It is not a store of wealth. The US dollar, gold is. And so gold is now being understood finally because the narrative by the banks and the governments, which is terrified of, well, they're terrified of rising rates and they're terrified of gold price rising because rising gold price is another symptom that your paper money is losing respect, trust, value, and power. And so that is a terrifying thing. But now, because of platforms like yours, articles like mine, and many others, and because of the movement of history, people are forced now to look at gold differently. Get past what even Warren Buffett said about it. Get past the propaganda, the narrative. Get to making your own judgments on simple math and history. Gold's been money for thousands of years. It will be a store of value for thousands of years to come. It's been money as a currency off and on, depending on regimes' debt levels. They go on and off gold standards throughout history. But countries that are in debt always get off a gold standard to debase their currency, to inflate their currency, whether it's ancient Rome, whether it's Weimar, whether it's the US dollar post 1971. All debt soaked nations, without exception throughout history, debase their currency to pay their debt crisis. And their debt is usually overspending, current account deficits, or paying for foreign wars, proxy or direct, and they're over their skis in debt. We saw that in 1789 France, 1720 John Law era, saw it in the 30s, saw it in the 90s in Yugoslavia, 30s in Germany. This is just history and math. It's very simple. And it's hard to believe that America, like the British Empire or the Dutch Empire or the Spanish Empire, could ever be anything but the great America. And again, we're not the same America we were in 1944. We're not. And we're in that moment right now. It's hard to accept. It's like the stages of grief. You start with denial. It's very hard. But again, not to be gloom and doom, it doesn't mean the end of America. We're just going from an America-led dollar, world reserve currency, and global economy to a more multipolar and frankly more multi-dysfunctional. Uh, and the reason gold is rising is because fiat paper money, including the sacred US dollar, just isn't trusted and isn't as powerful as it used to be. It's that mathematically simple. It just isn't. So
Gold
gold,
is doing exactly what it should be doing in times like this.
precisely, precisely. Yeah. And again, if you look at what gold did during the when the VIX was at 52, gold wasn't tanking like in 2008. The world's very different. And even when gold tanked in 2008 by 30%, it shot back to new highs because gold's role is more than just an inflation hedge. It's a volatility hedge in portfolios. It's a currency hedge. It's a rate hedge. It's a debt hedge. And I was a stock bond hedge fund manager during the dot-com bubble. I was an allocator for a family office. I'm very familiar with speculation and different tools for speculating, different avenues and different alternative investment vehicles and different hedge fund strategies. Nothing against speculating, but the simple fact is gold is outperforming those strategies and those assets because of this debt crisis, because everything else is falling apart gradually, slowly, and then all at once. Again, not the end of the banking system, not the end of the world reserve currency, not the end of America, but a very severe seismic shift and change, and certainly a severe change in the power of the US dollar. And again, gold is not there to make you rich like Nvidia or Bitcoin. You can't speculate that for the rich instant wealth. It's there to preserve whatever wealth you have and to protect you from the invisible tax of inflation and the debasement of your currency, which your central banks do to you every single day they're in operation.
Which is exactly why you and I have both sat here in this podcast and said it is important to also look at the historical
Hmm.
aspects and functions of gold for these reasons. Why would you want to have,
Hmm.
for example, $10,000 in your, bank account when you could have, I'll call it 3 ounces of gold for simple math.
Hmm.
Why would you want to have that 10,000 in fiat that's going to, continually go down in terms of
Right.
devaluation when you could just plot that into 3 ounces of gold? It's important that people read and understand what's happened before and what's
Hmm.
happening now and the key fundamentals that gold has.
Yeah, you got to follow the hockey puck, as Rain Gretzky says in hockey. You don't play where the puck is, you play where it's going. Why are central banks stacking gold at record levels since 2022 specifically, but since 2014 in general? Why? Why? Because they like to look at it? Because they want to make more jewelry? No, because they see the writing on the wall with debasement of currencies. They'd rather save in gold than US Treasuries as a strategic reserve asset. Why did the BIS make gold a strategic reserve asset? You save in gold and you spend in fiat. That's what central banks do. That's what our clients do at Von Greyer's. That's what Egon and I do. You save in something that holds its value. Of course, you can't take a gold bar into a grocery store or to buy a car, at least not yet. So you save in that gold and then you convert it to the currency when you need it, but you're holding its value while you're saving. Central banks are doing it. My clients are doing it. Our clients are doing it. You're doing it. It's common sense when you understand history and you're from the UK. Brown famously got rid of most of your gold in 1990.
Uh-huh.
And I joke often that, again, Indian housewives have more gold than the Bank of England. Now, what was Gordon Brown thinking? What was he thinking? He was a product of his times, of his arrogance and his ignorance, because he didn't understand history. But in 1990, this famous book by Francis Fukuyama, The End of History, The Last Man, this was this famous book. I was a sophomore in college, and the Soviet Union had just collapsed. The wall was down. America certainly looked at its height of popularity, and the theme of this book was, in a Hegelian way, history had now ended. Liberal democracy and free market capitalism are here to stay. And that came out in 1990, right around the time Gordon Brown got rid of all your gold. Who needs it? The dollar's great. The world is great. The West is one. That is an incredibly arrogant and short-sighted understanding of history, thinking in terms of cycles or publishing cycles or election cycles. But history moves in decades and quarters and centuries. So ignorant, such hubris before the fall. Because you fast forward some 30 years since Gordon Brown, and your country, the UK, has a currency crisis, a debt crisis, and it doesn't have a gold piggy bank like China, Russia, and other so-called developing economies, the little children of the world who are actually saving while the West was going into debt. And so, again, it doesn't mean China rules the world or that the yuan or the ruble are taking over. They have lots of problems, but they don't have this problem. They understand the direction of the hockey puck. England does not. The US does not. The West does not. And now we're starting to get nervous. And I worry because Ernest Hemingway said in the 40s, whenever you have a debt soaked nation, they have the temporary prosperity of debt, printing money or putting everything on a credit card. And then comes the permanent ruin of currency debasement and war. And you look at the West in Western Europe, and I'm in Europe now, you look at the UK and you look at these war drums. War is a distraction when you're desperate. The UK and Germany are not going to beat Putin in a land battle, but they're desperate. They need headlines. They need an excuse to get away from their mismanagement, their drunk driving, their gross negligence of their own monetary system. And as Hemingway warned, we're going to have debasement of currency and possibly war. The problem is, unlike the 1940s when Hemingway wrote this, we live in a nuclear era. It's not so easy just to go to war to distract your population. And you're from the UK. I live in France. My family's half German. I've been to the cemeteries outside of Berlin, Wiesbaden, uh, Ludwigshafen. I've been to the villages in France. I've certainly been to the American cemeteries of the Argonne. You've seen what the British lost at the Somme. The middle class and the average citizen is the fodder for the stupidity of their leadership, whether it's military or financial. It's grotesque. And I'm a capitalist and I'm all about making money. But you can't have this kind of wealth inequality. You can't tax the poor, draft the poor, kill the poor with distractions and lies. They've got to understand that as boring as money as a topic is, or bond yields as a topic is, when countries are in debt and their yields are rising and their income is falling, they do desperate things. And let's hope it's not war. But the very fact that we're even talking about war in Europe after this is madness. It's madness, but it's always been madness. Like I said, the cemeteries, the military cemeteries of your country and mine are madness. And yet, in the nuclear era, it's that option is to me less available. And so we're going to have trade wars and currency wars. We're not going to have cooperation. And gold is only going to rise in this chaos because it is chaos and because there is no easy way out of this debt crisis in the near term, certainly for the next 10 years. There's going to have to be constructive destruction. There's going to be a recession, a market mean reversion, probably bazooka money, and then some type of IMF quote unquote reset, which will be anything but orderly. It'll be highly
Mm.
centralized. You'll have CBDC and you'll have a digital ID in everything you spend. That's just the sad forecast.
And it's a forecast that I would say that I would agree with because it's all just part of this playbook, I think, that's coming down the line.
Mhm.
Matthew, we've covered so much today, and again, I think it's fair that we both, well, we would say that the emphasis has to be if we're going to take something out of this, it's please focus on that 10-year Treasury yield
Yes.
because that is absolutely imperative for
Yes.
what, as you say, what Powell's looking at and so forth.
Mhm.
Obviously, we've covered gold, we've gone through bond yields, we've touched upon history, what's happened
Mhm.
before,
Mhm.
preservation of wealth, and so forth.
Mhm.
Is there anything that we haven't spoken about before we leave? Is there anything we haven't spoken about that you think people need to know about, people should be made aware of?
I think you've hit all the big themes. I'm really pleased that you started with bond yields, boring bond yields. They're so important. Again, I'll keep saying, please just understand the basics of the bond market. Understand that economies that run on debt cannot afford expensive debt. And when debt becomes expensive, the house of cards fails. And the cost of debt is best foreseen and trackable in the 10-year yield or the 10-year bond of a nation. And the US 10-year is a key bond and a key yield to watch. The only other thing I would say that we haven't covered is I use this quote a lot from John Fitzgerald Kennedy. There's something immoral about abandoning your own judgment. Inform yourself. Don't inform from Rob and Matt. Inform yourself, study some history, study some economics, find the people that speak to you, learn from them, then make your own opinion, whether it's Bitcoin or gold, dollar strong, dollar weak. Go ahead and do your own homework, but have an informed opinion, not a narrative that you get from the government or the mainstream media. There's a lot of crazy in the alternative media, a lot of quacks. So it's hard to do, but find your own information before you just swallow what's told from the media or from your leaders, left or right or center, and certainly from your central bankers. Learn your own metrics, your own signals, and that 10-year treasury yield is a very, very important one.
Well, on that note, yes, thank you very much for again going into such depth and also layman's terms at the same time to really bring that to people's
Mhm.
attention. So a massive thank you for that. Of course, you're a partner at Von Greyer's Gold. So
Mhm.
how do people get in
Mhm.
touch with you? Because you're also on Substack and other platforms as
Mhm.
well. How do people get in touch with you?
Yeah, you can go to vongreyers.gold or goldswitzerland.com or vg.gold. Any of those URLs will take us to our website. Bod Greyers is a hard name sometimes to spell or remember, but you can also use Gold Switzerland. But Egon, who's obviously been way ahead of the curve on this for decades, not only created a website or a platform where you can learn about gold and how to own it, not just why to own it. He really created a system to preserve wealth and to inform people how to get gold and where to get gold. Now, not everyone can be a client of Von Greyer's. The minimums are very high, but anyone can get an education there. But it's very important to hold your gold outside of the banking system. It's very important to hold your gold in real physical form, not in ETF form. And we write about that and we show that. But Egon saw the writing on the wall. Again, he's a chess player, not a checkers player. He saw the writing on the wall decades ago, and he created an enterprise that solves the problem. And even for those who can't become clients because of our minimums, you can become educated there very easily. All these interviews, all our white papers, which go back years. There's a whole section on just why gold, and but in that whole section, it also talks about how to own it. That's free. That's just for yours to get educated on. And again, inform yourselves, and others can look at alternative views. But I think you'll find it's pretty common sense driven. You'll find that what we've been talking about for years has been correct, not because we have a crystal ball, but because we understand debt and we understand government realpolitik and desperation and currency debasement, which always follows a debt crisis.
As usual, all of the show notes and all the links to everything as well will be on if you're watching this on YouTube, they'll be in the description area. If you're on Substack, again, just go to the post that comes with this as well. Matthew, I've learned a lot as well today. So it's been a fantastic time to have a chat with you.
Mhm.
Maybe let's pick up this conversation at the back end of 2025 and see
Yeah.
what the lay of the land is then. But until then, yeah, I'll keep my eyes open for those bond yields and that gold price and so forth. And thank you
Yeah.
very much for your time.
Well, thank you for having me. I'm glad we could get these ideas out to more people. That's always good. Always a good thing.